Brad Williams, Frugal Finance, bonds, fixed securities. They are a tricky little devil in that understanding the terminology, the mechanics, if you will, of bonds can confuse investors. The question here, what you need to know about bond spreads. Investors who agree to take on more risk generally expect greater rewards. In the world of bonds, analyzing the size of the reward, typically in the form of higher interest payments, can provide you with clues about the risk of particular issuance and overall market sentiment. The difference between the yields of two different bonds is referred to as the spread. Typically, these spreads are measured in basis points, where 1 basis point equals 0.01%. The difference between a bond's yield compared to that of a relatively risk-free U.S. Treasury bond of the same maturity is known as credit spread. Determining a bond's credit spread is a common way to judge how much of a premium you could potentially collect for taking on more risk. Treasury bonds are viewed as some of the lowest risk investments since they're backed by the full faith and credit of the U.S. government. Because of this, credit spreads for other bonds are often calculated based on a comparison against Treasury bonds. Another type of bond spread is a yield curve spread, which involves a difference in yields for otherwise similar bonds with different maturities. For instance, the spread between a 10-year and a 2-year Treasury bond can indicate economic expectations. A widening spread often suggests expectation of stronger economic growth. For example, if we take a look at this information here, this is from the Treasury. This shows rates from 1 month out to 30 years. If you take a look here, this is as of 3/19/2025. We have a 1 month rate of 4.37, and we have a 30-year that goes out to 4.56%. If you put this on a chart, it would be 4.37 would be down here because it's 1 month. And as we stretch out this term structure, that's what it's called, put a dot here and you would see it would be up, and it would be sort of a curve. It would just yield up. And as we go out, you can go from 437 and you can see it's a little bit dippy here. You can see it goes from 437, drops to 410, down to 399. Then it pops back up to 456. It's called an inverted yield curve, sort of, because the long rate up here, you can see that last month, this was an inversion where the short-term rates were higher than the long-term rates. That's sort of indicator of uncertainty in the market. But this is what we're looking at in terms of the spread. You see from 437 to 456. We go back here to the subject at hand. We're going to see that what makes spreads change? Bond yields, the returns investors receive on bonds, are moving targets. They go up when bond prices go down and vice versa. Likewise, bond spreads get wider or tighter depending on several factors, including supply and demand, credit risk, and the overall state of the economy. Because a credit spread represents a relationship between a bond and a comparable Treasury bond, the spread may change because of factors affecting the bond itself, the Treasury bond against which it's measured, or both. An individual corporate bond credit spread might narrow as its credit profile improves, making it more likely that the company could meet its debt payments on time and in full. The spread could widen, however, if the company's ability to pay is in doubt due to, for example, a massive drop in sales. When investors pull money out of bond funds, which can happen for many reasons, the reduced demand for the bond included in a fund's portfolio can send the prices of those bonds lower. This can result in yields and spreads rising for those bonds. Conversely, strong demand for bond funds can lead to tighter spreads. Tough economic times also tend to shift credit spreads for corporate bonds higher. When the economy gets rocky, investors seek safe havens such as U.S. Treasury bonds, which sends their yields lower. Why? Think about it. Let's say you have a 5% bond. Remember, there's an inverse relationship here. If prices are higher, in other words, if there's a run for safety, in other words, in economic bad times, people will pull their money out of the stock market and start buying that 5% bond. Well, if you buy it, what happens? Higher prices, lower yields. You're going to have this supply and demand deal. More demand, it's going to drive up the prices, and it's going to temporarily lower that yield. Keep in mind, at maturity, this treasury bond is still going to be at 5%. But in terms of the interim, in between, that yield can change from time to time based on so many variables that it's inconceivable to talk about here. By watching bond spreads, investors can get a pretty good idea of the overall risk sentiment in the financial markets. Why do bond spreads matter? Credit spread between a corporate bond's yield and that of a comparable duration treasury bond can vary greatly between bonds of different credit ratings and bonds of different sectors within the same rating group. So while keeping tabs on the credit rating issued by agencies such as Moody's and S&P Global Rating is a good idea, paying attention to spreads can also help with your analysis of the risk and rewards of buying or selling any specific bond. For example, an unusually wide credit spread might indicate that the corporate bonds are undervalued, potentially presenting an investment opportunity. Understanding spreads can also help you diversify your investments across different types of bonds with varying risk and return profiles, aiding in the robustness of your financial portfolio. And bond spreads can serve as a barometer of the overall health of the economy and the credit markets. Wider spreads typically indicate higher perceived risk and economic uncertainty, while narrower spreads suggest stability. That's something any investors might want to watch, even if you don't own a single bond. I have a lot of different videos in terms of the finance side of Frugal Finance that shows the math behind all of this. Otherwise, just check out the various videos I have under my playlist, bonds or asset allocation, and it'll give you a little more insight as to the workings and the mechanics of bond spreads. Post questions if this is confusing. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.